Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, mate. How you been?
G'day, mate. I'm great. How are you?
Very good, thank you. Very good. The sun is shining here in Melbourne. It looks like it is up in Sydney, and it's 22 degrees. Spring is here. So,
well, again, Sydney beats Melbourne. We have 25.
What would be your perfect temperature?
Not a degree more than 25.
Yeah.
I really don't like too hot, and I don't like too cold. So I actually really like Sydney weather for that reason, is that most of the time it's pretty good.
Yeah, I think you guys are often, 3 to 4 degrees warmer than us, which I do get jealous of regularly. And also having the beaches in the city makes a big difference. But I'll take 22 because that's a pretty nice change. And I think if it's 25, right, you can go in the sun, you can get warm, but you can also be cool if you're inside. So it's a perfect balance. Before we got people listening to this from tropical northern Queensland, Darwin, overseas that are in much warmer, more humid environments, and I couldn't do it. I just couldn't do it, to be honest. So
I'm not a fan of humidity. Actually, that's one of the things. If you go to Cairns and places like that, in the summer it's kind of tough.
Oh yeah.
And I guess for those people who live there, though, they get used to it, right?
Yeah, that's it. Whereas they probably come down here and it's, at least in Melbourne, 7 degrees or whatever, in winter 5 degrees, and they're thinking, how do you do this? And we're looking up at them saying, how do you do that?
So do you think, we can do another tangent? I have a little story to tell. So I went to Bali once and, landed there. I see all these people wearing full pants and full shirt, colorful. They're not sweating. And I'm wearing basically stuff that people wear to the swimming pool, and I'm completely drenched. And for my entire stay, I was just always drenched in sweat. It was that. And I just looked at all the locals and said, how are you doing it? How does your body pores adapt to this thing? But they were completely fine wearing full sleeves and full pants. And, hey, the body's amazing.
Yeah, it is. And we're just maybe built for the southern states, you and I. I know I definitely am. You have to look at my skin and realize that I don't see a lot of sun. So anyway, mate, we've just here in Australia, we've just capped off our reporting season, which is always a bit of a relief for investors that take a close look at all the reports. And we've just jumped onto Twitter earlier today and had a bit of a chat to people who have requested some topics. So we're going to be talking about what you've been working on, what I've been working on. I'm actually going to share my screen quickly. Then we're going to dive into some companies. It looks like we've got about 6 or 7 companies to talk to today. Firstly, though, as always, if people do want to reach out to you, how can they find you?
Well, Twitter is the best place. That's the only social media I like to use. So just reach me out at 7A Mahanti, and come and say good day. Come and talk to us. Ask questions. If you actually ask me a question, I would probably give you an answer. You can even DM me there. And sometimes I actually do respond to the DMs if you ask me nicely. Right. And
and especially if it's an interesting company, right?
If it's an interesting company, sometimes, sometimes people say, hey, do you know anything about this? And they add a little prelude. And sometimes I go and look at it and it looks interesting. And I give them what I thought about it. And, it's just general thoughts that people can utilize. How about you? How are they going to reach out to you?
Same way, at Owen Rask on Twitter. So yeah, we're having a bit of fun with this. We try and crowdsource as much as we can. We've got some questions that have come through, and it's just good. I like Twitter when it's just like an open, kind of honest discussion about companies. I think it's just a really, really good resource because there's so many smart people on there. You just got to sometimes filter through the negativity. There's often, people pushing their own, talking their book, so to speak. And so once you get past that, it's actually a pretty good place to learn about all different types of topics, not just finance. So definitely jump onto twitter.com. We'll have the links there in the show notes too. And as always, you can watch this on YouTube if you're so inclined. We're going to probably share our screens a little bit today. So jump on there and say good day too. Mate, one thing that I know for a fact is that the first of every month is actually a very special time in your calendar and the calendar of 7 investing. So, and this is the first, when we say the first, we mean US time, if I'm not mistaken.
That's right. Eastern time.
Eastern time. So
before markets in the US open. That's right. So 7 investing, see, so this, sometimes people ask me this and I'll just clarify. So 7 investing basically recommends stock ideas, 7 stocks each month from 7 advisors covering a range of, risk reward, paradigms or, risk reward ranges. And those recommendations come out, before market open on the 1st of each month. And we put them on a scorecard. We then, buy the stock. Actually, we actually physically buy those stocks on our own in the 7 investing name. And so the new set is going to come out in a few hours time. And it's looking exciting. Again, I'm quite excited about my pick, which how do I give you a teaser? So just looking into
it's on Twitter. It's on Twitter. So we're recording this on the 1st of September, but the podcast won't go out until Saturday. But I know that, so it's Wednesday to Saturday. You on the 7 investing to Twitter. So at 7 investing, there's actually like a sneak peek at some of the industries, the risk levels, and the types of companies, like industries. And I can see here, Matt's got entertainment, Simon's in healthcare tech, Max healthcare tech. You're in enterprise software. You're given it moderate risk and it's a large cap. So there's 3 things. There's 3 teasers. Enterprise software.
Right. Yes.
Moderate risk and large
moderate
cap.
Risk and large cap. Now, large cap in the US means typically larger than 10 billion in market cap. Now, I have always contested that in from a US standard, that's actually more like a mid cap, but that's aside. We stick with with what is large cap. Yeah, but this is an interesting company. It plays into an area which is very, very important, but people would not associate this company with that particular area. And I think that's or let me put it. I'll tease out. It's in the cybersecurity space, and people do not think of this as a cybersecurity stock. But I think it's a fantastic cybersecurity play.
Interesting.
For the long run. So, and I personally own the stock. So,
and you did come out with a cybersecurity report last week, which I did put on Twitter again.
Yes,
there's a free report last week. So interesting. Seems you've been doing a bit of work in this field.
I mean, the cybersecurity. So the cybersecurity report. I'll just make this quick. Everyone should read it because I spent a lot of time writing it, and it's free. So you don't have anything to lose other than, I guess, giving up your email address, but it's free. And it really gives you, I think, a good view into what's happening in the cybersecurity space. Here's I'll give you one stat. The amount of economic loss caused by cyber threats in 2021 is going to hit $6 trillion. Okay, $6 trillion. Right, that's double of what it was in 2015, I believe, when it was $3 trillion.
Yeah, right.
So this is an issue for governments, organizations, enterprises of all sizes. You and I, everyone. So cybersecurity is a big deal, and there's a big paradigm shift happening, and that's what this report is about.
We've actually, so the RAS websites have actually been taken down, I think, 3 times now. No, get this, the first time was when I after years took a day off from work and I was on a plane. I was on a plane to Vietnam, and I was at Melbourne Airport in the international lounge taking off to go to Ho Chi Minh City. And as I was taking off, the websites got brought down by a DDoS attack and brought the websites down. And it was just a nightmare. So it's actually, it's like that old Peter Lynch thing.
Yes.
Peter Lynch goes away from the market and it crashes, like he has a holiday. for me, I go away from the business and it gets hacked. So I know this. I know this very well.
Yeah, this is a real deal. And you got hit by, I guess, Murphy's Law, right? You were leaving, and that's the day you get hit by a cyber attack. And, here's the thing, right? People think that cyber attack happens to, the Australian government's website or, the Medicare website. It does. Those are very high value targets because, you get a lot of attention, but it hits almost everything. And for some people, cyber attack is basically just fun. It shouldn't be fun, but it's like, okay, I hacked into stuff, right? And, and causes real damage, right? I mean, for people who wanted to access Rask on that day, couldn't until the site basically came back up, right? So
that's it. Yeah. So one of the things so the rec is coming out, or it's just come out by the time people listen to this, it's just come out. So you can get that by heading to 7investing.com/subscribe. But what we did was we asked for some ideas. I don't know, is this something that we're going to tackle today, mate? Outside Capital on Twitter asked for your take on strategic elements. I don't know if that's something you want to tackle today. Or?
No, so we said we're going to talk. Well, I need to look into it to tackle it. So we will do it maybe in the next episode, right? So again, if people give ideas, we're not junking your ideas by any means, but sometimes if you ask us on the day, we might not know about it because we don't know about everything. At least I don't know about everything. And
I know very few things, just for full disclosure.
So we take a pass on it, and I'll have a look, and we'll talk about it next time. We have a full slate today, right? And I know that you wanted to talk about something about Rask as well.
Yeah.
Some giveaway stuff. So I'm keen to hear about the giveaway stuff as well.
Yeah, sure. So before we get to this issue, I might actually try and let's just have a look. Can everyone share their screen? Okay. I'm just going to try and share my screen. I think I can. No, I can't. Monique, I know you're listening. Monique is our wonderful podcast producer. Monique, can you please allow Anirban and I the ability to share our screens? And while she's doing that,
this is the power today is with Monique. It usually is with. I'm at least happy I'm not the only powerless person today.
Yeah. So while she's hopefully doing that. Yes,
guys.
Okay, wonderful. Thank you, Monique. So I'm going to jump onto. You'll be able to see my Twitter page here. But one thing that we did last year was for our Rask Invest service, which is our membership service. We actually asked our community if they would want to put their name up and pick a stock, and we would put $500 hypothetical dollars into this stock. So all of our members, hundreds of members, picked a stock, and at the end of 1 year, which just so happened to be last week, we would donate up to what the value of that investment, that hypothetical money, up to $2,500. So meaning that if someone 5x'd their money with one pick, we would donate the full $2,500. And then they would get prizes like free memberships and all that sort of stuff. And there was the top 4 got awards. Well, I'm going to say this proudly that one of our members, Brant, picked a company called Lake Resources. And I hope you don't mind me giving you a shout out. Lake Resources in the last year, according to Google here on my screen, is up 1,800%. I think he 17x'd his money from the time of the pick to the time we did the results. So it was Brant, and then there were some wonderful additions in there, but I think it was like Brant, a bit of Blue Sky, and then the rest of us mere mortals. But what this means is that we donated $2,500, and I did this just before we came on air because I didn't want to just release the Rask Group's credit card to everyone. But we donated $2,500 to the Life You Can Save. And I'm just here on the website. We've had Peter Singer on the show before, and there are different options that you can do. The Life You Can Save was set up effectively to give effectively. So it analyzes charities for effective giving. And one of the really interesting things that I didn't know until last week when we were thinking about this is you can actually just come on their website and you can just select which option you want. In this case, I selected to give to the 90-10 fund. 10% going to the Life You Can Save, as in the organization itself that does all the research, and the other 90 went to the charities themselves. And it only takes $2 to save a life, which is incredible. That's for the net for malaria, to stop malaria spreading. But the reality is by the time it goes into shipping and cargo and freight and gets organized, it can cost a few $1,000s. So I don't know exactly what the stat was, but when Peter was on the podcast, I think it's a few $1,000s to effectively save a life. And so we've donated $2,500 to the Life You Can Save. And I don't say this to butter my own bread. I say this because I hope that other investors that are listening to this will go and donate. Because if we can get to $5,000 US, I think that is the level to save a life. So if you are out there and you do want to give to a great charity, or you want to give regularly, you can head to the lifeyoucansave.org.au. That's for the Australian website, and you can give. And this is a great way to do it. It's really effective because it's going to charities that do what they say. And it's a really interesting thing. So last time we were on just so you know, mate, last time we had Peter Singer on the podcast, one of our members or one of our listeners, I think it was $10,000 or $15,000 they donated. And that donation actually made it into the annual report for the Life You Can Save as one of the most interesting gifts for the year. So, wonderful cause, in my opinion, that you can give to. And thank you, Brant, for being such a great stock picker and going up 17x in 1 year and doing this and allowing us to donate this money. So wonderful. In a time like now, I think it's extra important. So that was my little pitch for a Life You Can Save in the middle of a podcast. The other thing that we've been working on recently is we've been doing a lot of live sessions. I know you guys do this, which is super cool, which, some really smart heads over at 7 Investing coming together, which is really, really powerful. The team you guys have is unbelievable. But yeah, we've been doing a lot of, live sessions for our members. And the other thing that we've talked about off air, you and I, just quickly, was that ETFs can be an effective way to get exposure to markets. So whether you're investing in Asia, you're investing, which we spoke about a few weeks ago, or you're investing in Europe or wherever, some markets that you might not have the time or the inclination to go and research yourself, ETFs can be an effective way to do that. So that's what I've been working on the last few weeks, mate. Now.
Yeah, I'm a big fan of ETFs. One of the things that I think ETFs are underrated in the sense that, we love picking stocks, right? So for those of us who love picking stocks, we're probably not going to pick ETFs for our portfolios, right? But a lot of people, maybe they don't want to pick stocks, right? But they should still invest, right? And if they want to invest, one of the ways you could do it is via ETFs. And you can actually, given the gamut of stuff that's available today on ETFs, you can actually build a market-beating portfolio. You can build a growth portfolio. You can pretty much build any different type of portfolio. Yes, you don't have that kind of control, but you can still build it. And with relatively less effort, still get great results, still get investments, still get the benefits of compounding. So yeah, I'm a big fan of ETFs. And and for many people, maybe ETFs are core, right? I mean, it can be a core, and then you sort of build your interest and you build portfolio on top of it. Over time, maybe you divest your ETF. But again, instead of term deposits, which don't pay anything, if that's you, then consider ETFs. Definitely, you get diversification at one shot. And as you said, you can invest in Asia, you can invest in America, and that's just country trends. You can invest in technology, you can invest in biotech, you can do it so many different things, right? And yeah,
I think it's a great way to build that core. To your point,
yeah. And it's a very powerful tool. It's one of the actually most powerful inventions, I guess, in finance, right? Usually products, if you think of products as, products that basically assimilate other things and build together something as, they're generally not good products.
No, they're not.
Not, but this, this is an exception. You take multiple things and you actually build something that's kind of useful.
Yeah. It just makes it easy to put things together, just building blocks of a portfolio. So yeah, fantastic. Maybe we can, if you have any questions around that, you can ask us on Twitter and we'll come back to do an episode on those. Okay, mate. So we've got some companies here. I think the format from last week was a bit of a hit, but what we might do is we might just jump through some companies, and we've got a good skew here towards US companies, which I'm really excited about. Number 2 in particular is the one that I'm really interested to hear your thoughts on. But maybe to kick things off, what we'll do is we'll talk about a company called Altium. So Altium is a company.
I love when people talk about Altium.
Oh, yes. Yes. Okay, here
Please
we go.
go ahead.
Okay, here we go. Altium came out. So, what does Altium do? Altium is a software company that does its software is used to design printed circuit boards. So, this is my iPhone here. Inside this, there's going to be effectively a motherboard or some type of PCB, a printed circuit board, and basically Altium software allows engineers and designers to design circuit boards. And it's actually got other software that now is in that ecosystem that even allows them to do things like search for parts and order parts and get costs for whatever they're designing. And then also on the other side, they're trying to push down the downstream into going into, or maybe upstream, downstream, don't know how you want to think about it, but in terms of getting onto the manufacturing floor. So they're trying to bridge that gap between design and automation, and then all the way onto the manufacturing floor. Now, Altium came out with its results. It was the one which you will know if you're a regular listener of the show, did get a takeover offer for $38.50. And I'm looking at the share price now, and the shares are $29.57 just a few months later. So it came out with the result this week. Shares dropped, and revenue was up 1%. Which not great for a company that's supposedly a growth company. Annualized recurring revenue, I think this is percent growth of ARR of 28%, and that's because they're moving into more subscriptions for their Altium Designer, which is great. If we come down, the number one slide for Altium for many analysts for a long time has been the flight path. The flight path to $500 million. Altium does like to use a few buzzwords. I don't know if flight path is a phrase that it's a bit of a buzzword, but it does make sense. It's what a lot of analysts use. And they have retreated from their guidance by about a year. And analysts did pick up that they dropped some margin expectations there too. So ultimately, if you go back to the episode we did previously, my opinion of Altium is that it's a good company, at least here in Australia. It's a strong contender, for tech portfolios. If Cadence Systems was on the ASX, or if Mentor Graphics wasn't part of Siemens, you might be inclined to buy some of that as well to capture this kind of connected manufacturing thematic. But in Australia, Altium's a really interesting business. We think it's worth a little bit more. Our valuation is a little bit more than the current share price. Hindsight's a wonderful thing. Maybe they should have taken the offer. Maybe we should have sold. That's probably it's probably, fault of mine, but Altium's an interesting business. Definitely one for your watch list if you're an Australian investor. That's all I got, mate. I mean, we could go into more, but we've got a few companies.
No, I was only going to say that the results were unaudited.
Oh, yes, unaudited.
That's the most interesting part, I thought.
Oh, yeah. And I believe, I could be mistaken, but I believe they were going to come out at the beginning of the month with results, said, no, we'll come out at the end of the month. And then at the end of the month, still didn't have audited results. But they weren't alone. There are a few other companies that come out with unaudited results. A lot of small caps. Adubba, which is another company that was, if you look at that report, that was my last report for the reporting season. So I was thinking I was a bit fried by the end of the month, but I was thinking, wait, this can't be right. Anyway, so there were a few companies that come out with these results. And I think a lot of them have struggled that have made acquisitions or divestments. So in the case of Altium, they've divested tasking, which is automotive part of their business. So maybe we can give them some leeway. I think under ASX relief and ASIC relief, they've got to still give us the audited results within a month. And they've got to announce if there is a material change that is found between now and then. So watch this space. Number two, what is number two? That was a bit of an interesting one. What's number two?
Well, number two on the company list is we've got Zoom, which is what we are using right now to record this show.
Yes, we are indeed.
So Zoom, as you all know, is basically a teleconferencing, video conferencing software. And you can also you can have Zoom phones, just like you can have Cisco phones. So it's basically a telco. It's a comms company, communications company. It's an immensely profitable company.
I was surprised how much free cash flow this thing produces.
This thing is an incredible. So I'll share a screen here, and we'll go from there. Okay, let's do that. So look at this slide here and look at this growth numbers. Okay, so people were unhappy that the stock actually fell after hours, and I think or doing real trading actually fell by 16%, something like that. That's because the growth was only 54% to a quarterly revenue of only $1 billion. People are unhappy with 54% growth that takes you to $1 billion. I don't know what they're going to make them happy with. This comes, again, it's worthwhile remembering that this comes on the back of
This is lapping.
This is lapping a 355% growth, 355% growth that they got during COVID. So this is basically growth at huge scale. And that 355 was on top of 96, right? And that's what the company is saying, like, just, this is phenomenal growth. Like, they're winning big time. And look at that expansion of those customers that are paying a lot of money with them, right? Huge. Then this is another number that I really like looking at, 130% dollar-based expansion. So basically customers that stuck around with them for over a year, they are now spending 30% more this year. This is 13th consecutive quarter. 13th
Definitely spending more than 130% of what I spent last year. I can tell you that much.
Yeah. So it is just unbelievably. This is unbelievable. This is free cash flow monster. Okay, look at the operating margin here. 42% is the operating margin. If you look at that, it's just, this is, yeah. So again, I guess I can't find any fault. Maybe the valuation is rich, like many other things that are growing at this scale and this quickly. I guess the only thing I can say about Zoom and you can constitute that, and I personally actually do not hold Zoom shares, I'll make that clear, and I've always thought that this space is going to be hyper competitive. There's, there's Microsoft Teams, there's, if Apple is launching FaceTime's variant, which is basically going to be looking like Zoom and actually enabling people to have these calls through the web. So basically only one person needs to have, an Apple product, and everybody else could be on a different product and they'll be fine. So it's very competitive, but I think this is very sticky, right? So those companies that have gotten used to using this are not going to get rid of it. They're going to expand usage over time. I think Zoom can continue, investing. So that's the growth story. And, they can get into AR and VR as they evolve over time to give you a more immersive experience of telecons or video cons over time. So I think as long as, if they can, continue innovating, I think they will continue winning. The margins are unbelievably good. The growth is just great.
I got to say, so Zoom is for us, because we do a lot of podcasts, right? Both you and I do a lot of podcasts, and Zoom is easier. It's more readily accepted. It's now a verb, I guess. Let's get on a Zoom, but it is less convenient if you're doing internal comms. So if you're on Google, you set a Google Calendar invite. You can automatically just click the Meet link and you go straight there. So that, or if you're using Slack, you just Slack each other with a huddle or a video, or if you're on Teams, you just hit each other up with the Teams. So that's interesting. And I often, that was always my concern around, where to from here for Zoom. And yes. I think, but that said, the multiple that you actually pay for shares, I'm just looking at the ticker terminal, actually come way down. And the company is extremely, profitable. And I didn't realize how profitable it was. So I know it made an acquisition recently too, I believe.
Yeah, so they bought the contact center company called Fiverr. Look, I think everything that you say is actually right? Now, I'd say that I think Microsoft has that advantage of, having Teams and everything integrated. Actually, one of the things, the trick, I think that Zoom missed was to actually merge with Slack. Actually, a merger with Slack would have created a killer combo. Yeah, and I think that's where the Microsoft has an advantage. Microsoft has another advantage which people don't realize, being the original enterprise software company, right? So, and again, I'm going to maybe nitty-gritty technical details, but a lot of companies have their directories are all Microsoft Exchange. So basically, your directory or your source of truth of who is employed, who is not, is Microsoft Exchange. Right. So when you have that software, and then you have got, of course, Microsoft 360 or Microsoft, basically cloud offerings, it gives you you basically have a foot in the door in terms of getting in and selling other things. So that's their biggest advantage. And that's a disadvantage, I guess, that these guys have. Again, I just don't understand why, Slack and this seemed like a natural combo. But yeah.
Yeah. Well, Salesforce got to it first. So
exactly.
Yeah.
Another great company.
Another great company, which we talked about last week. So
yes.
Jump back on the podcast archives to see that one.
What do we have next?
The next company we have is Jumbo Interactive. And actually, instead of going through the results, what I'm actually going to do is we're going to take a look at a quick question. You said to me before we jumped on that you're glad I'm looking at this one. So this is a great question. It comes from Julian. Says, with reporting season out, I have been reading an array of Rask articles, and Jumbo Interactive was covered by Lachlan. Great work, Lachlan. On the annual statement, JIN, Jumbo Interactive, boasts free cash flow of 28.6 million, excluding acquisitions and investments into business and strategic assets. When I look into the cash flow statement, it states that their free cash flow is negative 9.12 million. This would imply that the acquisitions and investments, which should be taken into account when stating free cash flow, amounted to $37 million. Looking at the cash flow statement, I can't seem to figure out where this is, and more importantly, how much emphasis should people put into Jin's statement that free cash flow is 28.6 million? Is that a marketing gimmick? I've been an avid listener to the Australian Investing Podcast and a member of our services. Wonderful, Julian. It'd be amazing if you could shed some light into this. So I don't know if we can see this, but here we go. So it looks like I always find it a really easy proxy for free cash flow, and this is kind of a sanity check that we had to play on ourselves this week, is instead of doing your free cash flow calculation straight from EBIT or net profit and going to NOPAT, for those who like to get into the weeds, which is net operating profit after tax, as a rule of thumb, what I often like to do is just take the net operating cash flows, this line item here that we can see, it's like the top third. It's at the bottom of the top third, if you can imagine that. And then you can subtract anything that's you think is, I guess, growth related in the net cash outflows from investing activities. So that next third down. And so here we can see $38 million and $35 million. And I would less the payments for other intangibles, which is $6.4 million, to get a rule of thumb on free cash flow. I'm not saying this is perfect, but I'm just saying this is kind of what I would look at to eyeball it. There was a $15 million payment here for the Tabcorp extension fee, intangible asset. So Jumbo Interactive is a software developer for gaming. Just so for those of you who don't know, listed in Australia, JIN is the ticker code. And so I would look at this and say that the free cash flow on a normalized basis is around 35 minus 6.4 million. So around that $28 million mark. Now you might be saying, well, why don't you include that $15 million in there, that $15 million that goes to Tabcorp? My answer to that question is that it's not repeating, it's not recurring. So I'm just trying to get a pulse check on the actual core business. I'd have to know more about the company to know exactly whether this should be included or not. But as a rough rule of thumb, Julian, I would take net operating cash flows less anything that I thought was, a normalized part of the spending to get that kind of core business as usual free cash flow is what I would value it at. Because things like this $15 million can throw your free cash flow models way out of whack if you're not careful. I don't know if you have anything to add on that, but that would probably be my really quick advice.
I think that's spot on. The only thing I was going to say is that if the Tabcorp thing, for example, is happening every 10 years, then it absolutely makes sense. Another thing you could do is you could just, you could basically say it's 30, 35 instead of, if you want to include it, you basically say, well, I normalize it over 10 years and depreciate it over 10 years. And basically I just take out, 1.5. The same thing actually with the other intangible asset too, right? I mean, if it is an acquisition, then what you want to look at is how frequently are they doing it? If, my rule of thumb is if they make an acquisition every year, then I take it out. If they make an acquisition every few years, 5 years, then I just sort of look at the ballpark figure and I'll just take the average out. But if somebody is a spiritual and habitual acquirer, then I take it out because their free cash flow is never going to bump up because they're going to just keep acquiring. So they need to generate the free cash flow, or the cash from operations has to actually make up more than that.
Yep. And that's totally the way I think about it too. There are some rules, if you go into CFA textbooks, if you go into like university curriculum, there are rules for these things. Sometimes it just comes back to imagining in a normal year, what would this business make in cash flow? And then that's the way I think about it. I think that's the way you should think about it, is in a normal year. And if they do need to pay for these things every year, well, then that's a normal year.
Take it up.
so consider that. But that's a great question, Julian, because people do get this and working capital are the two places where people get stuck. So great question, a bit technical for those of you that are listening, but rule of thumb, net operating cash flows, and then subtract anything that's kind of usual business from the investing cash flows. Okay, that was
I'm going to give a hat tip to that question. I mean, that's a great question to ask. And, somebody who's really wanting to actually figure out how investing works. So I love that. Great question.
Yep, wonderful question. Okay, the next one, which is interesting that you mentioned cybersecurity earlier on, mate, because now you're going to go back into it with CrowdStrike.
Oh, yes. Yeah. So CrowdStrike was, again, so CrowdStrike basically is what people call the endpoint protection software provider. What that basically means is endpoints are devices that people use for their day-to-day work, which might be like our, PCs or, MacBooks or laptops and devices like that, your smartphones, and you want to protect them. How do you protect them? Well, you could run a software, excuse me, provided by CrowdStrike. And the same software runs on hundreds and thousands of other devices. All of those, softwares basically collaborate with each other, which basically means that if there is a threat detected at, say, my machine, then Owen's machine is informed. So therefore you don't get affected, I guess, by the same thing as I do. Okay, I'm going to again share my screen here very quickly. Let's do share screen and the CrowdStrike. And I love their
Falcon
slides. Yeah, the Falcon and the slides. I like the color that they do. Okay, so this is, I'm just going to show you the numbers here. So I've just described what they do, the endpoint protection system. It's basically a platform, and there's a bit of a data, I guess, data network effects going on. So, more data helps them actually be more agile and build better AI models, which again helps them sort of, tackle what people call the zero-day attacks, right? So attacks that you've never seen before, or, signatures that you've never seen before, you're able to identify them. But look at this. Okay, customer, subscription growth, 81% year-over-year growth to 13,000. This is phenomenal. 64 of the Fortune 100, so 100 of the largest Fortune 100 companies use them. 200, about roughly half of Fortune 500 use them. And let's forget that. But let's look at some. They have a huge TAM. They expect the TAM to be about 44 billion right now. But if you sort of increase and look at some of the other things that they do, the TAM is really, really large, probably in the hundreds of billions of dollars range. But look at that ARR growth in this chart, right? I mean, if you look at the ARR growth, annual recurring revenue is growing at 70%, and it's $1.3 billion. That's pretty phenomenal. I've not seen that kind of number. I mean, Zoom and CrowdStrike throw numbers that basically look like, oh, okay, this is what growth at scale looks like. This is, again, a free cash flow monster. It generates a lot of free cash flow, really fast growing business, superb retention numbers. Again, as you see, they show the retention numbers here. If you're interested in security, this company should be on your radar. It's one of the companies actually I mentioned in my report, the cybersecurity report. I was
just checking that, actually.
Yeah, this is a company that you should really look at. It's a great, again, high margin software business that is really, really doing really well. Yeah. So
if I was to use CrowdStrike, would I have it? Is it installed? You say on the endpoint. Does that mean it's installed on, like, if I worked for a big enterprise, I would have it installed on my Mac here, as well as having it on the server that we have, or how does that work?
Yes. Did I stop sharing?
Yes, you've stopped sharing.
Okay. Yeah. So yes. So you basically install what's a lightweight agent. So basically, there's a lightweight agent that basically then talks with the cloud, right? So it's not like a heavyweight agent that's running on your system. And so basically, if you have devices provided by an enterprise, and the enterprise basically would install it, right? So if you have Mac devices, for example, there's a way for the enterprise to manage all the Mac devices. So they have business management ways of managing business computers. The same thing, if the endpoint, you can actually maybe be given a license by an enterprise to use it, and then you'd be able to collaborate and be part of the threat graph. So yes.
Okay, interesting. Yeah, because we don't use Windows anymore, but I remember having I think it was like Norton or
the antiviruses, right?
Yeah, AVG free on my computer.
Yes.
I thought this was back in the day when you would start up your computer and it would take a few minutes. You could go make some 2-minute noodles and then come back and it would still be just winding up. But then if you had some of these antivirus installed, it would take a long time to get the thing going even further. So
that's a great point, right? So what happened in the olden days, and stuff doesn't work that way, is that they basically downloaded in the olden day, the entire sort of, every now and then the virus signature file was updated, and that signature file was sent to your computer, and then your computer basically ran a scan on everything. Right. And remember, 5 years ago, our computers didn't have the ability to process as much as they do today. And you just imagine running through this entire gamut and reading this scan. So it's a really inefficient process if you think about it. It was the best that you could do then. Now we sort of, offload the processing requirements to the cloud, right? So you just have this agent running, and that's basically sending part of the information that it needs across to the cloud, right? And yeah, it's very interesting tech.
Fascinating. Okay, so the next company on my list is a company called Pointera, which is an Australian company, small cap company, even though it went up about 14x last year. You can see here, it is still quite small. So just pay attention to the currencies too here. We can see that ACV was up 241% compared to 2020 at $9.8 million US. Headcount, the number of staff in the business is now 29, up from 12. So it's increasing its sales force in the US, but also its engineering and customer support teams. We can see it's got customer cash receipts of $4 million. So if ACV is a bit higher, you would expect revenue to go higher and cash receipts to go higher in the next year. Customer revenue, very close approximation to cash receipts, which is interesting conversion there. That's good. $4 million. It's got $5 million of cash in the bank. I think total cash flow was slightly negative if I come down to the cash flow statement. Yeah, so we can see here that net operating cash flows was a negative flow of 254,000, and the investing cash that was used to invest was 137,000. So going backwards on that metric. So Pointera is a business that does basically data management for huge data sets. So if you're a surveyor or you're a someone that is involved in sort of like geospatial data, you can use Pointera. I was actually chatting to the CEO, Ian Olsen, not too long ago for our members, and he was saying in some instances, if they want to get a huge amount of data off premise and into the cloud for analytics and whatever, they'll actually work with someone like Amazon, who in their AWS team, they have trucks that are actually basically giant hard drives on wheels. They'll go to the place where they need to get the data and they'll run cables into the building and then transfer off the local servers onto the AWS mobile hard drive, take it to the server farm and push it into the cloud from there. And that just gives you an idea of how big these data sets are, these image data, these LiDAR, this 3D. So basically the game changer for Pointera going forward should be it's move into this thing called Insight, which is it's partnered with HERE, the global automotive data company, and basically what it's trying to do is it's trying to not just allow people to analyze data, which is what it currently does in the cloud, these huge data sets, but also to automate a lot of the signals that come from that data. So things like if something has changed in the local council, send that push notification to someone in council to say, hey, there's graffiti on that chair when it was just surveyed, send someone out to go and fix it. And so things like that, like straight away, you can go and do that. And I think that's, it's going to be a tough thing to crack in terms of that's a big market with some big players. Pointera charges a subscription fee, which is reasonable. One of the concerns we had was around how does it scale its data? If Amazon is charging it, let's say $1, 1.5 cents per gigabyte or something, and it's got terabytes upon terabytes of data, how does that scale? And it's actually the big concern in Ian's mind actually was, he said something interesting. This was going back a little while. He said that they spend $40,000 a month on cloud hosting, so not much. But he said half of that is actually used up by the R&D team, just iterating and testing things. and so that's gives you an idea of like they're spending more money on iterating than they are on actually doing it. It's a tiny company with a high valuation, so keep that in mind. But Pointera ASX 3DP is the ticker code.
I was going to quickly say that the valuation is half of what it was not too long ago.
Oh yeah.
It's
And this is the thing.
It's
an impressive technology business, but I don't think it's as fast growing as what people thought it was or think it is. They're still, I think they're just brought on a chief marketing. Well, they're trying to bring on a chief marketing officer, so they're still growing the actual team. So I think when we first recommended them, I think they had 7 people in the team or something tiny. So it's like venture capital-esque. So keep that in mind too.
All right, it's like a startup.
Yeah, it's like a startup. Now it's kind of evolving out of that to scale up, I guess.
Scale up, yeah.
So we've got 2 more companies, and these are both from you. One of them comes from a friend of the show, so we say. 2 more to go, mate. What's the second last one?
The second last one is a Brazilian company called StoneCo. And I'm going to share my screen. So StoneCo, I'll quickly describe what it is. So StoneCo, for those people in Australia who are familiar with it, is a bit like Tyro. So basically they provide, point of sales solutions to SMBs. And it's a bit like Square for those people who are now familiar with Square because of Afterpay. It's a bit like Square because they've got software solutions that they sell. They do a bit of lending to the customers or the merchants to help their businesses grow. It's a fast growing business. Those people who are fans of Warren Buffett would know or may know that Warren Buffett's Berkshire Hathaway has a small position. Actually, maybe not small, a decent enough position, maybe 5% or something less than that in that company. I'll share my screen quickly to just make it interesting for people. And come on, fire up. And you'll notice
come on, Zoom. What are you doing, Zoom?
That's
no wonder your share price is going down.
It's and it's never my Apple's fault.
No, Apple couldn't do anything wrong.
Apple couldn't do anything wrong. So if people have seen the Square reports, they would notice that it's very much like that. They have this machine showing up here. So I want to highlight something. I love the transparency these leaders have. Look at this starting. Despite strong underlying growth in our core business and evolution of our strategic roadmap, we had some mixed results this quarter, primarily driven by challenges in our credit product. So they had some issues with the credit product. They've actually stopped issuing credit right now and they believe that they've increased sort of the potential for loss on some of the credit that they had issued because of some issue with the Brazilian receivables registry system. Credit receive, it was called dynamic registration of credit receivables in Brazil. Again, I don't know the full details. I do own stock in this company, and people will say, "Why don't you understand the full details?" Well, sometimes you just can't, which is the true fact. But what I want to show you is what I think this company is really doing really well.
Isn't it great? Sorry, mate. Sorry. Isn't it great when management open up with something that wasn't positive? I love that. It's just straight up. It was great, but here we go.
Yeah. That gives me so much more confidence in what they do. And, it tells me that these guys are honest and really are running a great business. They want to run a great business, do it the right way, and they'll be right by everyone, which is really, really important, I think. Look, so the results were great. I mean, the total payment volume was up. So, in Brazilian currency up roughly 60%, total revenue was decreased because they had this negative contribution from the credit or basically the loss reserves that they're taking. The SMB client was up, by 188,000. The take rate was down, but again, if you exclude the credit issue, the take rate was actually up. And I love this. Many companies wouldn't do this because most companies would report the net income line and the EPS line because on the GAAP basis it was profitable and would look great because it was up actually, significantly. But they actually report adjusted numbers because that's what really matters in this case, right? So they had adjusted loss. Again, I thought everything was great. And the other thing I'll point out is one graph that's interesting to look at is sort of what again, the growths were fantastic, even with respect to the first quarter, right? That's again important for many of the things that they're doing with respect to first quarter. They had significant growth, which is really, really interesting. The company probably has a long runway here to run, and again, there's going to be many ups and downs here. And this company, as I said, is never shy of trying things. And if it doesn't work out, not shy of changing strategy, which I think is really good, which is what you need to do if you kind of want to disrupt. Usual risks with this area is it's in Brazil. Brazil's inflation can be a problem. Brazil's growth can be a problem. But Brazil is, again, an emerging market with really high growth. It's got what's interesting about Brazil is that they're pretty high up in the Gini Human Development Index. It's a large population. It's a big economy, and so there's a lot of hope and potential there, right? And this is a new age software company that's sort of trying to disrupt basically the incumbent banks, which is sort of like Tyro, but just in a bigger market to think about. So, but I think with a lot of more software angle in their thing.
I saw that it added 188,000. It looked like it was net additions for small and medium enterprise clients and that takes them over 1 million. So it's not a small business if it's got 1 million terminals or gateways in the market. That's a meaningful business. So yeah, fascinating. Okay, cool. So that's the second from last. We've actually got one. Did we save the best for last? I guess we'll find out. We will find out. And this one comes from Claude Walker, friend of the show, has been on before, former colleague of both of us. Claude said, can you look at Unity with a Y? Unity, UNITY. Now, some of you might be thinking of Unity with an I, which is an Australian telco, kind of embedded telco company. This is a different business. So, mate, can you tell us a little bit about Unity and anything you know about it?
So Unity is a software company that specializes in sort of providing framework for making video games. And they provide sort of two frameworks for creating and developing games, where they basically compete with Fortnite. Or what is it? Yeah, it's the Unreal Engine. So basically compete with the Unreal Engine. Then you have the Unity engine, and then of course have a framework for sort of hosting and managing and running games, for doing things like in-app purchases and things. So you need frameworks for doing that. That's what Unity does. But I think a lot of people think of them as just a gaming company. What is worthwhile to think about here is that a lot of companies, automotive companies, for example, would use Unity's software tools for imagining, visualizing things. Right. And so it is also a lot of creative solutions that use Unity. Right. And the other thing to remember is, I think if you are thinking about a world where, the term metaverse has now become quite common, thanks to Facebook. But if you're thinking about of a different world order, right, where you have things like augmented reality, virtual reality, and a different experience to, for example, watching television or watching sports or interacting in video cons, then all of those things could be impacted by software development that would need the basic frameworks that are provided by things like Unity. So I think Unity has, again, a long runway there. I'm going to just share. I'll not share that one. I'll share this one, actually.
This is a really interesting business. It's kind of like at the picks and shovels level of the metaverse. And also,
exactly.
I'm a big, I used to be, I still love my video games. And I tell you what, they're just so immersive, right? And so every year there's something new that comes and it just changes the paradigm, it seems. But companies like Unity and the Unreal Engine, the creators behind those make all of those other games possible. So I constantly think about these types of companies.
Exactly, like things like Roblox, for example, right? They run on Unity. So what was interesting about this result was really strong. So nearly 50% year-over-year growth for the quarterly revenue to about 270 million, which was so they've basically crossed the billion revenue run rate, growing at about 48%. Let's say even they're growing at 35%. That's pretty significant. And then, as I said, they operate sort of two divisions. One is called sort of the operate division, which basically operates or runs things for various gamers, and then the create, which is really the creative space. The create is actually the smaller component of the thing, but I think the create is the one which has a lot of blue sky potential. And as they say, right? I mean, we think of this as metaverse and games and a few different companies, but games like Roblox to creation destinations like companies like Nvidia, Unity and Adobe, all of these, are already Snapchat or Facebook. All of these things can be touched by AR, VR, tech, and these guys are sort of at the picks and shovels really of that space. I thought really good results they had, and strong guidance as far as their expansion rating, and this is something that I'd like to talk about, was 140%. Right, so people are spending a lot more with this business over time, which is again very significant, right? And the other thing people need to really realize is maybe it's easier to change your video con system, but if you have developed a game and you're actually making revenue off that game from the App Store, you're not going to change your underlying provider, right? Because that is basically risking revenue. So you're not going to do that. This is a very sticky revenue-based business, right? And strong business momentum, as I said, raised guidance. They expect $1 billion in revenue. That's about roughly. I think they usually like to under promise over deliver. So they're saying slightly less than 40%. I think they'll do somewhere in that 40% range. It's an expensive stock at roughly 35 times trailing sales, or 35, 36 times actually forward guidance, which is basically 6 months out. Expensive, but again, if you believe in the future, there are a few different ways in which you can play. One way to play, easy way to play the AR, VR is to sort of assume that Apple is going to be the one that's leading the charge, right? And going to come up with a device that's going to change the game. And then there's going to be a bunch of other people who are going to build on top of that. And Unity is going to be one of them that's going to provide the picks and shovels. But yeah, I really like it. I've got a small position in this company just because of the picks and shovels play. It's not a big one, largely because, again, I don't know. One of the things I always worry about in an area like this is if it's all about gaming, then I think a lot of power here goes to Apple in terms of what they do and what they bring and what they have in plan, right? And how their plans sit with other people's plans. So I think that is really important to understand. They have not been impacted by Apple's privacy changes, so that's really good.
Have you ever read, seeing that Claude asks just to talk about this, have you ever read The Guerrilla Game? The book?
Yes.
The Guerrilla Game? Yeah. I think that's a really neat, that framework for analyzing companies, investing in high technology companies, I think is the tagline for that. And it probably applies to this type of industry too. Like you said, there are multiple ways to play it. You might be able to get exposure to a bunch of these companies that are kind of leading the charge, and then consolidate after a few years once you know who's winning.
That's right.
Consolidate into the leader.
So my strategy, actually, I love that, Owen. What you're basically suggesting, build a basket. Yeah. So if you really like this, build a basket, and like I say, my basket is led by Apple in this case, and then I have some other peripheral players that I invest in, and I might increase my position in the peripheral players as I see them evolve. But I like their execution. The execution. So this is for Claude Walker from The Rich Life, or for A Rich Life. A Rich Life, and now shout out to him. I think I really like the company. Got a position, not a big one, but again, a company that I think should be on your watch list because it's in a very exciting space.
Yeah, especially if it can expand beyond, like you said, expand beyond the gaming vertical and go into these other adjacencies like film and entertainment. We had I did a special promo with Jerry Sakis, who's the founder of PlayStage Studios. He came on and he was on for our members. He did an interview, and then I shared it here on the podcast. And he was saying that The Mandalorian, which is the Disney show, was shot with a screen behind it that was basically like I think it was the Unreal Engine that was powering the screen behind it. So rather than using, green screens and whatever, they actually just had a big screen run by the Unreal Engine and graphics behind it to give that kind of, where he's on different worlds or whatever. I'm not sure if you've seen The Mandalorian, but it's fascinating to see where these companies could go, and really exciting. So if you're a gamer, chuck it on your watch list. Even if you're not, maybe chuck it on your watch list. If you like The Mandalorian, chuck it on your watch list.
So I'm going to just quickly say, somebody said talk about Disney.
Yes.
We have talked about Disney now.
There you go. Yep. Mandalorian. It's
Mandalorian.
I would give it a, yeah. Even if you're not a Star Wars fan, you know, my partner's not a Star Wars fan, and we got into it. It's good. It's a good show. Great, mate. I think that takes us through all of the companies today. So if people wanted to get their mitts on this enterprise software company that you, by the time this goes to life, you would have just recommended, where can they go to get that?
Well, go to go to 7investing.com/subscribe and use the Rask code to get $10 off, right?
Yep.
Don't forget the code.
Don't forget the code.
Don't forget the code. And for full disclosure, Owen actually doesn't make any money off it. We did offer him. He kindly declined. There's nothing in here for Owen other than just, some love for us. But yeah, check it out if you're interested in the rec. But yeah, it's going to be interesting.
Yep. And there's the free report, which will be in the show notes again. So check that out. Like Anirban says, he wrote it.
It's free.
It's free. So
it's free. Read it, please.
Someone,
please read it. I spent a lot of time, and I drew some diagrams there.
Yeah, that's it. That's the secret.
That's the secret.
We I can't remember who it was on Twitter. Was it Jason? Said, "Are we going to talk about our Apple Watches?" Just gonna say, we love the Apple Watches.
Love Apple Watch.
Yeah, it's right here, so it's got to be brought up.
Also, Apple is a really neat story. Again, we're going to do a tangent. So when I got this Apple Watch, I got the titanium version, and my boss, or the boss of the boss at that time, asked me, "Why did you buy the titanium version?" I was like, "Well, I really don't know. Well, I just bought it because I thought titanium sounds cool." Well, now I have a reason why the titanium is cool. So my little, German Shepherd puppy, when he goes and sees the watch on the charger, he likes to grab it.
Oh,
well, it doesn't get scratched by the German Shepherd puppy's teeth. So I really like the titanium version now. So the titanium version actually has a use case.
Once again, Apple has thought of everything. And it was actually Terry that mentioned it on Twitter. But yes, it's a good recommendation. I think I said to you last time we were on that we've given one away on our other podcast, or we're giving one away. And it actually has made a difference. Like all the Rask team has one, and it does make a difference during lockdown, just even being able to exercise and feel healthy and track your sleep. And so easy.
I'll suggest the Rask team should wear two, one for the left hand, one for the right hand. It's good for me.
Yes. I bet it is. It's probably not good for if we provide those, but my pocket might hurt. But it's high on the list of recommendations. Another thing is, I did mention this. I've been waiting for about a month for the new iMac. It should be here any minute now. So,
did you get a 24-inch screen?
Yeah, got the 24-inch. Yeah.
Yeah.
See, I've got the bigger one here, the older one.
Mm-hmm.
I think it's 28. Shout out to Ricky on Twitter, who's an Apple reseller. He got me this one, but the new one. I'm very excited because then I don't have, the camera quality is a lot better. Anyway, we're obviously Apple shareholders. We
can have another show. As I told our correspondent on Twitter, we can have a full show talking about Apple products, and we will not be bored. I'm sure some people will be bored, and those people who believe in Android will be really bored.
They will indeed. They've already switched off.
They've already switched off. This is a great chat, Owen.
Always fun, mate. Thanks for joining me.
Thanks, man.